Hi, welcome back to my channel where we break down complex NetSuite concepts into simple and fun to understand steps. In today's video, we're going to walk through the order to cash process from order creation to customer payment, highlighting the key GL entries along the way. Let's get started. Let's begin with the accounting equation. In accounting, every transaction involves both a debit and a credit recorded in the general ledger, and this is called double entry accounting. So we have the famous accounting equation where assets equal to liability plus equity. We'll explore the accounting equations and financial statements in another video, but the only thing you need to remember for now is this table. So always remember this little table, take a screenshot and store it somewhere. So now we'll look at the order to cash process. The order to cash process is critical business function that starts when a customer places an order and ends when the payment is received. Now the process can be broken down into several key steps. So of course we'll have our customer master onto NetSuite, and the process will begin with the creation of a sales order when a customer places an order. From then we are going to fulfill or ship the items, and this is where the items are going to be picked, packed and shipped. Next, invoicing. So once the items are shipped, an invoice is generated and is sent to the customer. And the last step is receiving the payment from the customer, which closes the transaction. Now let's take a look at each step in more detail, starting with item fulfillment and its impact on the general ledger. Now, since a sales order has no GL impact, we'll focus on the other transactions. So, item fulfillment. This is the stage where the sales order is partially or fully shipped. In this example, let's say we have a sales order for 10,000 and we are going to ship all the products of the sales order. The two accounts that are going to be impacted are going to be inventory account and our COGS account. Now, always remember the little table that we showed in the previous slide. Inventory is considered to be an asset and it is located on the balance sheet. And since we are reducing our stock, a decrease in the asset column would result in a credit in our inventory account. On the other hand, COGS is like an expense account and it is located on the income statement. COGS, cost of goods sold, track the cost associated with fulfilling the item, and thus an increase in COGS would result in a debit. Now, this item fulfillment step ensures that both our inventory and cost accounts are accurately updated to reflect the goods shipped to our customer. Next step is invoicing. So once the items are fulfilled, an invoice is generated. This step has a significant impact on two accounts. So we have first our revenue account and second our accounts receivable. Revenue is located on the income statement, and in this example it is credited since we are recording the income earned from the sale. On the other hand, accounts receivable. So AR is considered to be an asset and it is located on the balance sheet. It represents the amount the company expects to collect from the customer. In this example, we are increasing our AR, thus resulting in a debit. Now, the invoicing process ensures that the financial records reflect the revenue earned and the amount owed by the customer. The last step in the order to cash process is receiving the customer's payment. Now, when a payment is received, the following GL entries occur. So first we have the bank or cash account, and then of course AR. Since we are receiving money into our bank account, there's an increase in our assets, and thus that would result in a debit. And on the other hand, since we are reducing the amount owed by the customer, our AR account would get credited. This step completes the transaction in the financial records, ensuring that the accounts accurately reflect the payment received and updates the customer balance. So, to summarize, the order to cash process is a series of steps from order creation to payment receipt, each impacting the general ledger. SO has no GL impact whatsoever. Item fulfillment affects inventory and COGS account, invoicing impacts AR and revenue accounts, and customer payment will update your cash or bank accounts and reduce the accounts receivable. So at the end, you cancel out the balance in your AR, and what's remaining basically is, well, you sold some stuff to your customer, you receive payment for it, and these are recorded on your balance sheet. On the other hand, you also need to record the revenue you earned and the costs you incurred, and those are recorded on your income statement. So understanding this GL impact is crucial for maintaining accurate financial records and ensuring your business financial health. Thank you for watching.